Hi, my name is Jim and I was retired. This is going to be a little I-bond redux, another video on I-bonds, but here I'm going to talk about a gift of tax diversity with I-bonds. Stay tuned. Hey, if you have not yet subscribed to this account, please do so. I'm about 850 subscribers and I'd love to get up to 1,000. The higher it is, the more it'll show up in the search results. Please hit that button for me. Thanks. In this short video, I'm going to follow up on the subject of I-bonds. I'm going to show you how my wife and I made a gift of I-bonds to each other. But more importantly, I'm going to discuss the gift of tax diversity with I-bonds. Now, as I mentioned in our last video, my wife and I found out a way of getting over the $10,000 per tax ID limit on purchasing I-bonds. We don't have a business and trusts seem too complicated, but you can gift each other I-bonds in excess of your $10,000, but you can't deliver those $10,000 in I-bond gifts to a person until they have a free up of their $10,000 that they're allowed to purchase. But we could lock into these high rates now by gifting each other $5,000 gift bonds to be presented in 2023 out of our gift boxes. And that still will allow us another $5,000 in purchase that we could make next year depending upon how rates go. So I'm going to explore a little bit about how we purchase the I-bond gifts and also talk a little bit about the three tax buckets: taxable, tax-deferred, and tax-free, and how I-bonds actually give you a little bit extra diversity in your tax buckets. Stay tuned. So the first thing I want to go through is how to purchase an I-bond gift. And I have a short video that I have already put together from the purchase that I made for Marie's bond. And you go to Buy Direct on your Treasury Direct account, and then you select the kind of bond that you want to make, an I-bond. To make a gift, you need to specify who the gift is going to. And in order to do so, you need to create a new registrant. The main registrant on your Treasury Direct account is you. So you have to add this new registrant. Here I'm entering the information for Marie. Now, most importantly, when you get back to making the purchase for that new registrant, you're going to make it sole owner, and you're going to go down to the bottom and make sure you hit that button that says this is a gift. That'll put your bond into the gift box. Now, once you've completed the transaction, you'll get a confirmation that you've bought a gift for your recipient. And you'll see that it's here in the gift box. Now, I'm not going to do anything here until 2023. So in 2023, you're going to go in and change the information in the gift box to transfer that gift to another person's, to that recipient's Treasury Direct account. They do not need to have a Treasury Direct account now. If you want to make a gift to your spouse and they haven't set up the Treasury Direct, you could go ahead and make the gift, leave it in the gift box until 2023 or later this year when they set up a Treasury Direct account, and then present the gift once you have that information of the Treasury Direct account. But for now, I'm leaving this in the gift box. Marie has made a reciprocal gift to me of $5,000, and it's remaining in her gift box. That means we have purchased $15,000 each in I bonds at these historic rates, even though $5,000 apiece aren't going to be presented until next year. Now, I'm going to talk about the added gift of tax diversity with I bonds. If you recall from prior videos, I operate on a principle of 3 time buckets as well as 3 tax buckets. The time buckets are a time allocation of assets, what I need near term, what I need intermediate term, and what I don't need for a long time. The tax buckets are taxable accounts, banks and brokerage accounts, tax-deferred accounts, which are the main way people save for retirement. You take pre-tax dollars, put them in a tax-deferred account, and they don't get taxed until later. And tax-free accounts. You pay the tax up front, put it in a Roth account, and then you can make withdrawals from the tax-free accounts at any time without any taxes. Now, there are limitations to when you can pull things out, but assuming you're in retirement like I am, most of those limitations are beyond you. You cannot purchase an I bond from a tax-deferred account or a tax-free account. You can only purchase an I bond from a taxable bank account. You can use your Schwab checking account if you'd like, but that's a bank account. But set up a permanent banking account with your Treasury Direct account. It's very complicated with signature guarantees and everything if you have to change that bank information later. So make it an account that you're going to use for quite some time. Here's the secret about tax diversity. Taxable interest is taxed each year in your bank account. But in your I bond Treasury Direct account, interest is not taxed until you redeem the bond, either partial redemption or total redemption. You could wait 30 years until the bond matures, then redeem it and get all of the interest at one time. Or you could redeem early, but whenever you redeem, you're going to be taxed on that interest. Now, if you make a partial redemption, if you have a $10,000 bond and you only redeem $5,000 of it, then you will only get half of the interest taxed at that time. The rest of the interest will remain deferred. This flexibility gives you an added bonus in retirement. You can now choose between a tax-deferred interest in a taxable account, the I bond, or a tax-deferred account from your IRA or your tax-free Roth account. Now suppose, for instance, I had a $15,000 air conditioner that needs replacing. I could withdraw from the tax-deferred IRA or 401k, but I'm going to pay a tax on that entire $15,000. Or I could realize capital gains from my brokerage accounts, and I'll pay a capital gains tax on the money that I generate to withdraw from the brokerage account to pay for that expenditure. Or I can withdraw $15,000 from my Roth and not pay any taxes because it's a tax-free account. But let's go back to I bonds. Withdrawing $15,000 from an accumulated market value in your I bonds allows you to be taxed on that interest, but not the principal. So $15,000 withdrawal from your I bonds will have interest associated with it. That'll be taxed, but not the principal. So it'll be slightly different than a tax-deferred withdrawal from your IRA, where everything is taxed. Here, only the interest is going to be taxed. And that gives you some flexibility in your spending plans as you move forward. I hope that idea helps. It's a little added bonus of I bonds. If you have not purchased your I bond in April, you got one more week to do it. I'd get it done by Wednesday or Thursday of next week at the latest, so that you allow the processing to make sure that your bond is purchased by the end of April. If so, it'll be dated April 1, and you'll be off and running with your I-bond interest. I'll conclude with my standard warning. I am not a financial professional. I have no initials after my name. So take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one.